All right, let's dive in. Today we're tackling the world of meal kits, specifically Blue Apron.
Oh yeah, Blue Apron.
Remember those? They were like, I feel like they were everywhere for a while, just promising to make, cooking gourmet meals a breeze.
Yeah, totally. They seem poised to like totally revolutionize the way we eat.
Yeah.
So we've got a business school case study here that dissects like all the challenges that they faced. And then we've also got a session plan that kind of looks at the whole Blue Apron story through this really interesting lens of customer lifetime value.
Okay, customer lifetime value.
Yeah.
That sounds a little technical.
Yeah.
So break it down for me, like, why should we even care about this?
Well, so think of it this way, right?
Uh-huh.
Like you have some customers who are just kind of, flitting from one deal to the next.
Right.
And then you have those loyal folks who like stick with you through thick and thin.
Mm-hmm.
And Blue Apron's story is kind of all about like figuring out which of those customers is actually worth investing in.
Okay, I'm intrigued. So yeah.
Paint the scene for us. Like, how big was this whole meal kit craze back then?
It was huge. Like in 2017, the U.S. market was valued at like $4.65 billion.
Wow.
Which is up from just $1.5 billion the year before. So this industry was just exploding, and Blue Apron was like leading the charge.
Uh-huh.
They had a 53% market share in 2016.
53%.
Yeah, it felt like they were about to take a giant bite out of like the entire grocery market.
Right.
Which is, by the way, worth like $800 billion.
Yeah, that's a big market.
Yeah.
So if the market was like booming, what went wrong?
Well, that's where things get interesting.
Okay.
So Blue Apron was just like laser focused on growth.
Okay.
And they were pouring tons of money into attracting new customers.
Right.
But here's the catch: their customer acquisition cost, or C as it's known,
Right.
skyrocketed.
Okay.
It went from like $63 in 2015 to $100 in 2016.
And then to make things worse, those new customers weren't spending as much as the ones that they'd acquired earlier.
Wait, so they were spending more to
Okay.
get customers who are spending less?
Exactly.
That's not a good formula.
That's a recipe for disaster.
Yeah, that's bad.
Yeah, and it all boils down to this idea of customer lifetime value, or CLV.
Okay.
It's basically a way to figure out how much profit you can expect to make from a customer over their entire time with your company.
So it's not just about getting them in the door.
No.
It's about keeping them coming back.
Exactly. It's like a restaurant, right?
Yeah.
You don't just want people to try it once.
Right.
You want them to become like regulars.
Exactly.
Yeah.
Yeah.
And so for a subscription-based business like Blue Apron, CLV is crucial.
Okay.
And guess what? Their customer retention rate was dismal.
Okay.
Like only 28% of customers were still around after 6 months.
Ouch. So they had this huge churn problem.
Yeah.
No wonder their growth strategy was backfiring.
Right.
So, but how do you actually calculate this CLV thing?
Well, so initially they were using this model that was very simple.
Right.
And it kind of assumed that all customers behaved the same way.
Okay.
But that was a big mistake.
Mm-hmm.
It completely overlooked the fact that there are different types of customers,
Right.
each with their own spending habits and loyalty levels.
Yeah, you've got your like hardcore foodies who are in it for the long haul.
Yeah.
And then you've got the people who are just hopping on the bandwagon for a discount.
Exactly.
Yeah.
They realized that they needed a more nuanced model,
Right.
that would account for those differences.
Okay.
And that's where this two-segment model comes in.
Okay.
It basically acknowledges that there's like some customers who are high loyalty, and then there are those who are low loyalty, often the ones who are kind of, lured in by promotions and stuff.
Right. So how did this two-segment model like change things for Blue Apron?
Well, it revealed a pretty shocking truth.
Okay.
A whopping 54% of their customers fell into that low loyalty segment.
Yeah.
They were spending a fortune to acquire customers who were just there for the deal.
Yeah.
No wonder their CAC was through the roof.
Yeah. I'm starting to see the connection here. Like they were attracting the wrong customer. But like how did that actually impact their bottom line? Like what did their CLV look like for each of these segments?
So to calculate CLV, You have to consider a bunch of different factors.
Okay.
You know, how often a customer orders, how much they spend per order, and then the profit margin on each order, what's called the contribution margin, and then you also have to factor in this thing called the discount rate.
Okay.
Which basically accounts for the fact that money today is worth more than money in the future.
Right. Time value of money.
Exactly.
Yeah.
So there's a lot of moving parts.
Yeah, a lot of moving parts. So what did the numbers actually tell them?
Well, the results were pretty stark.
Okay.
The high loyalty segment had a CLV of $166.60.
Okay.
But those deal-seeking low loyalty customers, they had a negative CLV.
Oh no.
Of $80.
Negative. So you mean they were losing money on each?
They were losing money on each of those customers.
Wow. That's crazy.
Yeah, and to make matters worse,
yeah,
their customer acquisition costs just kept climbing.
Right.
In 2016 and 2017.
Mm-hmm.
And by the first quarter of 2017, they were losing money on average for every new customer that they acquired.
That's insane. So they were basically just caught in this vicious cycle.
Vicious cycle.
Yeah. Spending more to get customers who were costing them money.
Exactly.
So, but while all this was happening internally, like, what was the competitive landscape looking like?
Right.
Were other companies like facing these same challenges?
Well, the market was definitely heating up.
Okay.
You know, big players like Amazon and Walmart were starting to kind of sniff around the meal kit space.
Right.
And HelloFresh, which was Blue Apron's main rival,
right,
was quietly gaining ground.
Okay.
They had a much more stable CAC, and their sales were steadily increasing.
So Blue Apron is not only like struggling with its own internal issues,
right,
but it's also facing like a whole new level of competition.
Yeah, it was kind of a perfect storm.
Yeah.
And that brings us to Brad Dickerson.
Okay.
Blue Apron's new CEO.
Right.
He was stepping into like a pressure cooker.
Yeah.
You know, faced with some really, really tough choices. Like, how do you turn around a company that's bleeding money with a flawed growth strategy in a market that's just getting more crowded by the day?
Yeah, so talk about a challenge.
Yeah.
So did Dickerson have any tricks up his sleeve? Like, did he manage to pull Blue Apron out of this nosedive?
Well, that's what we're going to explore in part 2.
Okay.
Stay tuned.
Okay, so Blue Apron is in a free fall here.
Yeah.
Burning through cash, facing like all this fierce competition. The new CEO, Brad Dickerson.
Right.
He's got his work cut out for him.
Yeah, he did.
What were his first moves?
Well, you know, it wasn't a quick fix, that's for sure.
Right.
You know, they had just gone public.
Right.
The hope was that, you know, the IPO would inject some much needed capital, you know, give them a boost.
Right. IPOs are usually seen as like a sign of success, a chance to raise a ton of money and expand. So did it work out that way for Blue Apron?
Not exactly.
Oh.
They tried to like rein in their marketing spending.
Okay.
Hoping to slow down that runaway CAC train that we talked about.
Right.
And they poured resources into launching a new distribution facility.
Okay.
Thinking that would, you know, streamline things.
Right. So they were trying to get like more efficient, make
Yeah.
their operations leaner, but did they manage to fix that customer churn problem?
Well, that was the real Achilles heel.
Okay.
You know, even with less marketing, they were still losing customers faster than they could replace them.
Okay.
You know, their active customer count plummeted by 17% from its peak in early 2017.
17%, that's got to hurt.
Yeah.
So what happened to their revenue?
Well, predictably, it took a hit too.
Yeah.
You know, their net revenue fell by 14% in that same period.
Oof, not exactly the trajectory you want to see as a newly public company.
No, not at all.
It's like they were trying to like patch up holes in a sinking ship.
Yeah, pretty much.
What about the competition? Were they feeling the pressure too?
Well, that's when things got really interesting.
Okay.
Remember the giant lurking in the background?
Yeah.
Amazon.
Oh, yeah.
So right around the time of Blue Apron's IPO, they went and acquired Whole Foods.
Okay.
And then, boom, they filed a trademark for a meal kit service.
Oh, no, that's a classic Amazon move. Just like
disrupt an entire industry.
Disrupt the whole thing.
Yeah.
I bet that sent shivers down some spines at Blue Apron HQ.
I'm sure it did.
So it was a clear signal that the market was about to get even tougher.
Absolutely.
And it wasn't just Amazon, right?
No.
Wasn't Walmart also kind of like...
Walmart was muscling in.
Yeah. On the meal kit arena and like other big names too, right?
Yeah, you had Albertsons. Even Martha Stewart was getting in on the action.
Wow. So Blue Apron is suddenly facing like an army of competitors, many of whom have like way deeper pockets and more established supply chains. So how did their stock react to all this?
It wasn't pretty.
Okay.
Their stock price tumbled 18% in the first quarter after the IPO, and then another 19% in the second quarter.
Ouch.
Investors were getting spooked, realizing that maybe Blue Apron's future wasn't as rosy as it had seemed.
Yeah, Wall Street can be brutal.
It can.
So while Blue Apron was floundering, what was happening with their main rival, HelloFresh, weren't they kind of in the same boat?
Well, here's the surprising thing.
Okay.
Even though their 12-month customer retention rate was even lower than Blue Apron's, about 12%. They were actually doing much better.
Wait, lower retention but better performance overall. How is that possible?
Well, they had a couple of key advantages. Right. First, their customer acquisition costs were much more stable, hovering around 80 euros.
Okay.
And second, their sales were steadily climbing.
So they were more efficient at attracting customers who were actually valuable to their business?
Exactly.
Interesting. What about their IPO? Did they go public around the same time as Blue Apron?
Yeah, just a few months later.
Okay.
And their IPO was much more successful.
Okay.
It seemed like they had struck a better chord with investors. Perhaps they were seen as less risky.
Right.
Or maybe their focus on operational efficiency was more appealing.
Yeah, it's like they had cracked the code.
Yeah.
While Blue Apron was still struggling to find the right recipe for success.
Right, exactly.
So back to Blue Apron.
Yeah.
With their stock plummeting, the competition intensifying, what did Dickerson do to try and salvage the situation?
Right.
He was facing a real make-or-break moment here.
He was.
Did he have any bold moves up his sleeve?
Well, that's what we'll uncover in part 3.
Okay.
It's a story of adaptation, trying to find a new path in a rapidly changing market.
Okay, so the pressure is on, right? Blue Apron's stock is tanking. Rivals are popping up left and right. And everyone's waiting to see if Dickerson can pull off a miracle.
Right.
What did he actually do?
Well, he made some pretty big changes, trying to steer the ship in a new direction.
Okay.
One of the most dramatic moves was shaking up their fulfillment operations. Basically, how they get those meal kits from the warehouse to your doorstep.
You're right.
They decided to partner with this company called Fresh Realm, which basically meant outsourcing a big chunk of their logistics.
So instead of trying to do everything themselves, they brought in like an expert.
Yeah.
Makes sense. Logistics can be a real headache.
It can be.
But how did this actually help Blue Apron?
Well, it freed them up to focus on what they did best. Okay. Or at least what they hoped they did best, which was crafting delicious recipes, building a strong brand, and cultivating those all-important customer relationships.
Right. Win back the hearts and stomachs. Exactly.
Of their core customers.
Yeah. Yeah, those loyal foodies who maybe got tempted by the competition.
Right. So less time packing boxes, more time perfecting that seared salmon with roasted asparagus.
Exactly.
Did it work? Did they manage to stop the bleeding?
Well, it's a mixed bag.
Okay.
On the one hand, their stock price never quite bounced back to its IPO glory days.
Okay.
But on the other hand, they did manage to stay afloat.
Okay.
And in this cutthroat market, that's an achievement in itself.
Survival's a victory, right?
It is.
Especially when you've got like giants like Amazon breathing down your neck.
Totally.
But I'm curious, were there any other like factors that played into their fate? Any unexpected twists or turns?
Well, actually, yes.
Okay.
Enter the COVID-19 pandemic.
Oh yeah.
Remember those early days of lockdown when everyone was suddenly cooking at home?
Well, that actually gave Blue Apron a temporary boost.
It's funny because the pandemic was such a strange time.
It was.
But it's like the whole world was suddenly obsessed with like baking sourdough bread and trying new recipes. So did this surge in home cooking really translate into more business for Blue Apron?
Absolutely. They saw a noticeable uptick in sales and customer engagement.
Oh, okay.
It was like the stars aligned
Yeah.
and gave them this unexpected lifeline.
Right. So the pandemic, of all things, gave them a fighting chance.
It did.
But was it enough to like truly turn things around?
Right.
Or was it just like a fleeting moment of relief in a larger downward trend?
Sadly, it wasn't enough to create a lasting turnaround.
Okay.
While the pandemic did provide a temporary reprieve, they couldn't quite capitalize on the momentum.
Mm-hmm.
And in November 2023, Blue Apron was acquired by Wonder Group.
Oh, wow.
For $13 a share.
An acquisition, that doesn't sound like the fairy tale ending everyone was hoping for.
Not quite.
What was the company valued at in the end?
So the acquisition valued them at $103 million.
$103 million. That's a far cry from their $1.9 billion valuation at their IPO.
Huge difference.
It's a stark reminder of how quickly like fortunes can change.
Right.
Especially in the fast-paced world of tech and food delivery.
Absolutely. It's a roller coaster ride, that's for sure.
It is. But even though Blue Apron didn't become the culinary empire that some predicted,
right,
their story offers like valuable lessons for anyone running a business.
Totally.
Especially one built on a subscription model.
Yeah.
So let's wrap up with those key takeaways.
Bye.
What can our listeners learn from the Blue Apron saga?
Well, first and foremost, customer lifetime value is king.
Okay. CLV is king.
It's not enough to just acquire customers.
Right.
You need to attract and retain those who are truly valuable to your business.
So focus on building loyalty.
Yeah.
Not just chasing fleeting trends.
Exactly.
Makes sense.
Well, remember that there are multiple levers that you can pull to boost customer equity.
Right.
You can play with pricing, innovate with your products, become more efficient at acquiring customers, or really nail your operational excellence.
Right.
It's about finding the right balance for your specific business and market.
It's like a chef, like tweaking a recipe, constantly adjusting, refining until it's perfect.
Exactly.
Any final words of wisdom for our budding entrepreneurs and curious listeners out there?
Always keep the bigger picture in mind.
Oh.
Don't get so caught up in chasing growth that you lose sight of profitability. It's like a marathon, not a sprint. Pace yourself, make smart choices, and focus on building something sustainable.
Well said. Blue Apron's journey may have been turbulent.
It was.
But it's a treasure trove of insights for anyone, navigating the world of business.
Absolutely. And remember, if you're ever grappling with a business puzzle, we're here to help. Just send us your sources.
Okay.
And we'll dive deep into the data, uncovering the hidden gems of knowledge.
So there you have it, folks. The roller coaster ride that was Blue Apron.
Mm-hmm.
It's a reminder that even in the face of fierce competition and unexpected challenges, there's always something to be learned.
Absolutely.
Until next time, happy exploring.
Bon appétit.